We are living in a time where financial markets are moving faster and become more unpredictable than ever before. Every day, new information, policy changes, and global events are reshaping the way investors think and act. In such a dynamic environment, making the right investment decision is not only about chasing profit, but also about understanding risk and seizing the right opportunity at the right time. However, challenges often come with opportunities. Sectors such as technology, renewable energy, and digital finance continue to grow strongly and attract significant investment. In Vietnam, the financial market is showing encouraging signs of the recovery. Government support policies, improving economic conditions, and more stable interest rates are helping to restore investor confidence. The stock market is gradually gaining momentum, and new financial products, especially in fintech, are creating more investment choice. Nevertheless, the market still faces several challenges, including risk in the corporate bond market, liquidity issues in the real estate, and vulnerability to global economic fluctuation. Therefore, investing today is not only about maximizing return, but also about carefully managing risk and making well-informed decisions. However,
in our investment strategy, since the group had already allocated funds to higher risk channels like stocks and mutual funds, it is necessary to include low risk options to ensure our safety.
The gold prices over a one-year period from April 9, 2025 to April 9, 2026 provide a comprehensive overview of gold price movements during the year. Overall, the price of gold increased significantly from 2025 to 2026. Thus, within 1 year, the price of SJC gold increased by approximately 67.67%. Assuming that the gold price continues to grow at the same annual rate of 67.67% over a 3-year period from 2026 to 2029, an investment of 100 million Vietnam dong in gold would yield an estimated profit of approximately 371.38 million Vietnam dong.
We allocate another 50 million Vietnam dong to bank savings.
The gold price group has chosen to deposit saving at Military Commercial Joint Stock Bank, MB Bank, because it's one of the banks offering stable and competitive interest rates in the market. For a deposit of 50 million dong at MB Bank for a period of 36 months, the applicable interest rate in the provided table is 7.5% per year for deposits under 1 billion dong, with interest paid at maturity. Based on this rate, the total interest earned over 3 years would be 11,250,000 dong. Therefore, at the end of the deposit term, the total amount received would be 61,250,000 dong, including both the principal and the interest. This calculation assumes one-time deposit with interest paid in full at the end of the 36-month term, without renewal or compounding.
Aiming for a 37% return over 3 years means we need an annualized return in an unpredictable global economy carries high risk. That's why we are allocating a significant portion of 300 million Vietnam dong into top-tier mutual funds. It allows professionals to navigate volatility for us. We are focusing specifically on two funds, VNDAF and VCF. The reason why we choose this fund is that VNDAF actively invests in a large cap company with outstanding business performance in a volatile market that strict filtering criteria, focusing on corporate capacity and sustainable growth. As a safety net, they are actively adjust their portfolio to minimize risk, which is exactly what I wanted for my 3-year goal. The second allocation, my team chose VCF, the leading stock investment fund. This is managed by VCF, a joint venture involving Vietcombank, one of the most prestigious financial institutions in Vietnam. Why did we choose this specific fund? The core reason is their value investing strategy. As noted in the fund's description, they have a longest operating history among VCBF funds. They expect them through research to find undervalued, large cap, and highly liquid stock on the HNX and HNX. Having a fund backed by Vietcombank's deep market insight, benchmarking against the VN100 index, gives us confidence that our capital is protected by true fundamental allocation.
Vietnam 2026 stock market may feel loud and confusing. Short-term speculation is everywhere, while global uncertainty still linger. It is business actually making real money. That mindset led to a 40 million Vietnam dong investment, split evenly between VSC and HTG, based not on emotion but on the financial data, industry positioning, and long-term thinking. VSC by concept is not the kind of company that grabs attention. It operates port, container, logistics, nothing flashy, but that is exactly why it's reliable. More importantly, VSC isn't just sitting still. By the end of 2025, it had accumulated nearly 24% of HHH, effectively linking port operation with shipping. This creates a closed-loop logistics system from factory to port to vessel, capturing value across an entire chain. This impact shows clearly in the number. In 2025, VSC recorded 681 billion Vietnam dong in net profit, up 130% year-over-year. A standout example is Nam Hai in Port, which went from losses to generating 145 Vietnam dong in profit in just 1 year under new management. With Vietnam continuing to attract strong FDI inflows, demand for port and logistics service should remain solid. If BSC maintains its historical growth rate of around 27.6% annually, or 20 million Vietnam dong investment could grow to roughly 41.5 million Vietnam dong after 3 years. HDG tells a different story, less about expansion, more about consistency and discipline. The company has a long track record of paying strong cash dividends, including a 25% payout, 2,500 Vietnam dong per share at the end of 2025. At the price of around 42,100 Vietnam dong in April 2026, that's an attractive yield compared to paying deposits, plus the potential for capital grants. In late 2025, the company made a decisive move by exiting an underperforming associate Hoa Thọ Phu Ninh, choosing to focus on higher margin segments instead. That kind of discipline is rare, compared with low input costs and recovering export demand from markets like the US and Japan. HDG has a solid foundation for growth. At an annual growth rate of about 38%, 20 million Vietnam dong investment could reach approximately 52.6 million Vietnam dong in 3 years.
In the context of Vietnam recovering stock market, I choose this stock, XSG, XVT, and MBB for a 3-year investment. Plus, it has improved. XSG, a leading steel company with a large market share and an extensive distribution network. The steel industry is recovering into complete investment. And XSG is expected to grow about 12% annually. After 3 years, an investment of 20 million could grow about 28 million. That is hotel, XVT, operating in industrial parks and technology sectors. The company benefits from foreign direct investment inflow into Vietnam with an expected growth around 50% per year. After 3 years, 20 million could reach approximately 30.4 million. Finally, MB Bank is financially strong bank with stable growth. Thanks to digital transformation and strong management, MBB can grow around 30% annually. An investment of 20 million could reach about 29 million after 3 years. In total, investing 60 million in these 3 stocks could grow around 90 million after 3 years, equivalent to nearly 50% profit. This is a balanced portfolio, growth and safety, suitable for 3-year medium term.
I work in market making for cryptocurrency.
If you have an opportunity to do a portfolio investment, which portfolio will you invest in?
Do you have options? What kind of portfolio?
Cryptocurrency, saving, gold, stock, bond, something like that.
I would definitely diversify. So I would go for maybe some percentage into cryptocurrency markets and more into stocks markets. And of course, if you take
stock?
of course, yes.
Me too.
So if you take stocks, I would also take different countries.
Yes.
For example, USA, Europe, Asia, and to divide it into like parts, something like that.
Yeah, I think gold.
Oh, gold.
Gold.
Oh no, because I work in crypto. So for us, crypto is like digital gold.
Yeah.
So for sure, it's like old-fashioned. So I never invested in gold.
Oh,
I see. But gold is very risky. It can go down very fast, right?
Yes.
So stocks are usually more stable.
Yes, I like
For me, at least. Yeah.
Yes, thank you.
Of course, no problem. Nice to meet you.
Yes,
Thank you.
Okay, as you know, in the world of set with get rich quick scheme, our team is taking a different path. We are moving away from the high or 10 volatility of cryptocurrencies or the complex of leverage of derivative. Instead that, we've engineered a quad-core portfolio focused on risk-adjusted return. So why did we say no to the bonds, derivative, cryptocurrencies or foreign currencies? And how do we balance growth with absolute capital preservations? Let's break the logic behind our diversified approach. First of all, let's talk about bonds. Regarding yield, government bonds don't really offer a competitive edge over traditional savings. For most individual investors, the simplicities and transparencies of a saving account are much more appealing. Moving on to corporate bonds, although they offer higher returns, they come with substantial credit risk. Assessing the financial health of an issuer is a complex task that requires deep financial expertise. Without this, investors face a real danger of default or delayed interest payments. Finally, we must consider liquidity. Unlike the stock market, the secondary market for bonds is often illiquid. This means you might get stuck with your investment or be forced to sell it at a very unfavorable price when you need cash urgently. In conclusion, white bonds are a vital part of the financial market. They're not a one-size-fits-all solutions. For retail investors without deep financial expertise, the trade-off between the slightly higher yield and the significant liquidities and credit risk may not be justifiable compared to the safety of. First of all, in the
current financial landscape, investors must carefully consider a range of risks and challenges that could significantly impact their investment outcome. Firstly, in terms of risk, market risk remain one of the most prominent concerns. Financial markets today are highly volatile due to global uncertainties such as inflation, interest rate change, and geopolitical tension. As a result, asset price, especially stock, can fluctuate sharply in a short period of time. Secondly, liquidity risk is also critical. Some investment channels, particularly real estate or certain bonds, may not be easily converted into cash when needed. It can create difficulties in urgent financial situations.
In terms of challenge, one of the key difficulties is the need for accurate and timely market information. In a fast-changing environment, investors must continuously upgrade their knowledge and respond swiftly to new development.
We hope you can make the right investment decision and wishing you success in investment journey.